This morning, things looked okay. The trading rooms were quiet. There really wasn't much selling. A little bit of liquidation selling, people taking profits. As this Libyan thing began to escalate, at least through the media, the S&Ps did drop. We fell through a very important 1311 support level. Actually, right now as we speak, we're hovering right around there at 1311. Pretty encouraging, given the oil has rallied almost 18% in 2 weeks. At the S&Ps actually have held 1311. So the close is down, but much better than it was even 2 hours ago.
Larry, have we, over the last a few months, I suppose, one of the major themes on US markets has been this resilience, this, I suppose, bullishness at all costs, people buying on the dips. Did we see any of that effort today?
Well, yeah, and think of it this way. It's like the last 6 months, this market's been artificially pumped up, liquidity-driven, cheap money going into commodities, into equities. But people are starting to realize, hey, that's one thing, but we're not addressing the other issues. We can't have these surprises, these shockwaves in the market that causes oil prices to go up so much. And it just wreaks chaos, actually. But it's important also to mention that there wasn't any mass liquidation of single stocks right now. It seems to be ETF-driven and index-driven, and it seems to be people taking profits, not laying in short in the market.
In terms of this concern over Libya, this concern over the spread, the contagion of these uprisings within the region, we were getting some thoughts earlier about the impact this rising oil price will have, obviously with gasoline prices in the US, but then the flow-on effect in terms of consumer spending, consumer confidence. Is that becoming a worry?
Oh, a big worry, because it's not that we're at $100 a barrel. Actually, we're like $98. We did touch 100. It's not that we're at 100. It's how we got there. It was so quick to get to $100 a barrel. It could bring us back to 2008 in a hurry if things don't calm down, if things actually don't spread. Because the media is saying, hey, if Saudi Arabia starts to have disruptions, we're going to see $200 a barrel oil. And if that happens, I mean, good grief, we'll be back to 6,000 in the Dow. I mean, why not? I mean, nothing seems to be working in the economy. So with that said, we're just hoping that this is just a protection correction, as I call it, where, yeah, bad things going on in Libya. It's 2% of the global production. U.S. really isn't impacted with importing oil from Libya, but it is worrisome to some European nations, like the peripheral countries like Italy. They import 30% of their oil from Libya. That's a problem. Their economy's fragile. So there's a lot of moving parts right now, and if you have some gains, you might want to take them right now.
Do you expect, Larry, to see then that continued push into safe havens? We've been talking about the move, if you like, into US Treasuries, the move into gold and silver and so forth. Gold, I think, hitting about a 1-month high overnight. Is that a trend we're going to see continue?
I think so, but keep in mind, gold is really hasn't. I mean, it's gone up a lot in the last couple of days, but it's exactly where it was back in October. The U.S. dollar today definitely isn't a safe haven. The dollar is near its lows against all currencies, including your own. Should the U.S. dollar be considered a safe haven with the amount of problems that we're having, and our government might be shutting down in a few weeks? So the problem is, like, what is a safe haven right now? Is it Swiss francs? If you're worried about oil, I guess oil would be the safe haven, but the traditional safe havens aren't the same as they were even a year ago.
In terms of, I suppose, the continued upward trend of oil, is that just going to add to further inflationary worries that we're seeing, particularly around some of these emerging markets?
Absolutely, and that's the problem. It's like countries like Italy that are really going to struggle with this kind of oil price, and countries that have this the inflation problems and hawkish comments just came out in the ECB yesterday. Bank of England has 3 members now that want to raise rates. This is just going to add fuel to the fire. It's going to slow down global recovery, and it's going to be a domino effect into America. It has been said in a notebook that like a 1% rise in oil prices equates to like a 0.5% reduction in global recovery. But I mean, that's just a notebook economist viewpoint. The fact of the matter is the domino effect will come around very quickly because we depend on oil and the emerging markets have a big demand for it.